give you a little background on it. About 6 years ago, our firm was consistently being asked by managers as well as investors, what is the nature of capital flows? And we had all this great anecdotal information, but we didn't have anything terribly scientific. So we decided to partner with the Real Estate Masters program up at Cornell. Why Cornell? My co-founder, Doug Weill, go Big Red, or whatever they are these days. Big supporter. I don't think it had anything to do with the fact he was getting kids into college at the time, but we decided to fund research. They got in anyway, and that was not the issue. But his kids got in on sports. Both his daughters on sports, so that's good. But back to our study. We decided to go out and do a survey of the investors themselves, not the managers, not the consultants, not the fund-to-funds or other intermediaries, but the underlying investors. Because the real question was, how are you thinking about your target allocation? And in the first year of the survey, there were about 20 questions. It's now up to about 40 questions, and we'll come into it. But we approach about a little over 3,000 investing institutions around the world. The statistical analysis, we have been told by the academics who run the screen that this is statistically significant response, both in terms of the number of investors, but more importantly, the amount of capital that it represents. So all in for 2018, which was completed late last year, it's about 12 trillion of underlying institutional AUM, and you can see where it comes from. Interesting, but this past year, APAC was down. And why was APAC down? The prior year, there were lots of Chinese institutions that were still allocating and thinking about this, and then what happened? Kind of currency controls and other things were imposed on the market, and they stopped responding. I think in part because they didn't want to report that they weren't doing anything. But the numbers are out there. It represents, we think, a good cross-section of the global institutional investor community. So what were the key findings? Well, this won't seem like rocket science after a tutorial on closing a deal for Korean investors in Germany. But first and foremost, the capital continues to flow, and there's lots of statistical data behind it. 2018 results, we think, reflected that there were better investment results in 2017. So, what do we all mean by this? 2017, conviction had really dipped, among other things. Target returns were coming down. The latter part of 15, first half of 16, was kind of an odd market. And so by year-end 16, which is really what we were reporting on in 17, investors were seemingly pulling back. Ended up being better performance, so we saw that this increased investment result was actually having a positive effect on allocations. That said, and this is probably more true today than when this was first prepared late last year, there is a great deal of caution in the air about where we are in the cycle. And while everyone says situationally, we're not seeing a lot of dysfunction, we're not seeing imbalances, situationally it just feels like we've been having a good time at this for a long time. So, be more defensive than playing offensive. The fourth point, I think, is something maybe near and dear to the hearts of many people in this room, is where the capital is targeted for. Last year, we saw a decided shift away from the U.S. from investors outside the U.S. And the joke was people were going to fly from Seoul directly to London without making the requisite stops in a couple of key cities in the U.S. Our understanding is this is largely currency-driven. For many investors, going outside their borders and into another market is predicated upon a not less than return of X, and with currency hedging costs rising, the U.S. was falling below that line. We don't think it's a long-term issue, but we do know that it impacted results last year. And then last but not least, and near and dear to the hearts of many, including a lot of our clients, as much as investors are talking about being direct investors, they interpret that a lot of ways. It still requires them to work with other third-party managers, perhaps less so in traditional locked-up commingled funds, but lots of other vehicles have been organized around collective investing, more indirect than direct. So what's actually happening in the target allocation world? I see my longtime friend Jack Foster sitting here. He can remember back to the 80s along with a few others of us. Investors always wanted to get to 8% in real estate, and they were always chronically stuck around 5. And that was the nature of things for a very long time. Post GFC, which was when we really started to kind of dig in on this project, target allocations began to rise. And for many of the newer entrants, particularly those that were large sovereigns that came from outside the U.S., they were targeting much higher allocations to real estate, and it really has started to skew the numbers up. We can provide you the breakdown region by region of allocations. There is some consistency, but the newer entrants to the market out of Asia and parts of EMEA are definitely targeting at a higher level than U.S. institutions, which are now starting to ramp up, but not nearly as quickly. Since we've been doing this, the numbers have been ramping up. 2 years ago, we hit the magic 10% number. Last year, we rose another 30 basis points. It's been kind of growing in this 20 to 40 basis point range. And based on a question we asked, which is, do you think your allocations will continue to rise? We expect that it's going to rise again in 2019. Now, these are just allocations. These are not committed and invested amounts necessarily. And that's really what this talks about. They are increasing their allocations, and here we're breaking it down a little bit. You can see that in the Americas, they're pretty fully invested, so we're not expecting to see much growth. And if anything, the U.S. may represent a bit of a turning point this year where we've seen some investors start to say either cutting off new commitments or in fact stepping back or blending real estate into real assets. I think it was quite notable the other day, I'm sure other people picked up on this article that we reported on about Norges Bank not just stepping back, but shutting down. And that was a bit of a surprise given how prolific they've been, how much capital they have, how underinvested they were relative to their target. And it's a little bit of a head scratcher. I'm sure you'll get the rest of the story at some point, right, Richard? And then we come on to what I think is also a pretty critical point, and something won't surprise anyone here, but despite continually increasing target allocations to real estate, investors are not getting all that much closer to their ultimate promised land of full allocation. They probably never will, but as you can see, some of the newer entrants to the markets are a little bit kind of further behind. I would also say we can again provide more breakdown of this data. When you get into the Americas, big difference between above the border and below the border, i.e. Canada versus US in North America. The Canadians are still much more actively increasing allocations and increasing commitments than their counterparts in the kind of south of the border in the US. So when you look at that 90 basis point gap for the Americas, a lot of that is in Canada, and a small piece of that is in the U.S. I think the rest of it is kind of self-explanatory. Interesting, too, in 2018 versus 17, the APAC numbers have come down, in part, we think, again, because of the effect of a lot of Chinese institutions that have had constraints on their ability to deploy capital. We added the conviction index a couple of years ago, which is, I would say, on a scale of 1 to 10, how you feeling about the world. We were surprised to see that the conviction index rose last year relative to 2017 and what had been a kind of consistent downward trend. All this means is, yeah, we're continuing to invest just with a bit less enthusiasm. I referenced this earlier. 2017 actually turned out to be a pretty good performance year for a lot of investors, despite the fact that they thought it was going to be not a very good year. And as a result, we think they're just feeling a little bit better about putting out the capital. But as you can see, it was across the board. Lowest conviction is in the U.S. Again, a lot of the longest-standing investors, and followed by EMEA, which likewise, a lot of the European institutions have been investing globally for a long time. And a big snapback in Asia, which we have yet to figure out why they had as big a jump as they did. It may just be a couple of new entrants to the market.
Can I ask why the lowest conviction in the U.S.?
Why
the lowest conviction in the U.S.?
So that's a good question. I think they got back to investing earlier after the financial crisis. We think this is a big part of it. They were investing earlier, despite the fact that cycles don't end just because a bell rings after a certain number of months. There just is a sense in the U.S. that this cycle is pretty long dated, and while they're not expecting big calamities, they're more concerned about the risk out there as opposed to the risks that they've already acquired.
David, are you seeing or looking through it all to see that investors are preferring one asset class over another, and is that sort of masked a little bit by the data?
Well, we didn't get into asset classes. We got into risk categories,
Okay.
and you can see that on the slide to the right. These are split out between core, value add, and opportunistic. We got concerned that if we started asking too many asset class questions, they would shut the thing down.
Yeah.
We're up to 40 questions now. We still say it takes 10 minutes, but I took it took a little longer than 10 minutes. And I was making up answers since I was the prototype investor. If I had money, this is what I would use for it. I think that there is that shift, and something we can talk about at the panel. The shift in the U.S., I think, most decidedly away from, I would say, more commercial assets and into more demographically driven opportunities, and that's how everybody wants to wrap up the kind of the soundbite around how investors are moving their money. I think, though, that has probably less impact outside the U.S., where you have a lot of investors that are still just establishing the basic portfolio. I think the question earlier about why is conviction sort of dragging in the U.S., I think that there's a period of profound introspection going on, and that, I think, has to wash over a lot of things for the U.S. investors who are thinking about where and how. And just as an anecdote, sitting with a very large state pension fund recently, and he said for the last 5 years we've been kind of making vague references to having to adjust our portfolios to reflect climate change. And it's happy talk, and you know what, all of a sudden after another year of some pretty spectacular storms and losses, they're all saying, what, lenders are now starting to say, what are you doing? So I think that also, and I think those thoughts have already been had in a lot of the countries outside the U.S. It's a little slower to kind of progress here. But what is clear is that risk is out there, but it's not as much on as off. You can see that the highest target allocations, with the exception of Europe, which is we always think biased toward core, big allocations to value add, and at the expense of more capital going to opportunistic. Core is suffering, I'd say, the most in the U.S. because there's a sense it's more than fully priced, but maybe more importantly, most of the American institutions have established their core allocations, and they have the basic portfolio already in place.